In this video, I'm going over 4 of the best ETFs focused on artificial intelligence. Tools like ChatGPT and Midjourney keep making huge advancements that are going to affect every company on the stock market. So I looked through over 50 funds and narrowed them down to my top 4. Your time is valuable, so let's get right into it. Starting with number 4, which is TECB, BlackRock's iShares US Tech Breakthrough Multi-Sector ETF. This ETF seeks to track the investment results of an index composed of US companies that could benefit from various breakthrough technologies, including robotics and artificial intelligence, cloud and data tech, cybersecurity, genomics and immunology, and financial technology. In other words, you don't have to spend your time researching every single company that's investing in high-tech tools to become market leaders, because that's exactly what this ETF already does for you. So by purchasing shares in TECB, you're automatically giving your portfolio targeted exposure to companies focused on innovation. For example, out of the 183 stocks inside TECB, some of its top holdings include companies that you probably recognize like Meta Platforms, nvidia, Salesforce, Microsoft, and Apple. These companies are making some of the biggest moves in important areas like large language models, chip design and AI infrastructure, in-app copilots, and edge computing, and all of the other things that I talk about on this channel. And because this ETF holds such solid companies, it performed pretty well against the S&P 500. TECB has gone up by over 15% over the last 3 months, compared to the S&P 500's roughly 3%. It's doubled the returns of the S&P 500 over the last 6 months, and it's only down 1% more than the S&P 500 over the last year. And it's actually beating the S&P 500 since its inception a little over 3 years ago. That's not bad for a fund that focuses exclusively on tech stocks, many of which have taken a serious beating over the last few quarters. Now, you may be thinking to yourself, that's great and all, but if I really want AI stocks in my portfolio, I'll just go buy Tesla, or nvidia, or Microsoft, since they own 49% of OpenAI. And those are actually all great options. But for example, Tesla stock is down by around 30% over the last 6 months, while TECB is up by 20%. And Tesla stock is down by around 50% over the last 12 months, while TECB is down by only 15%. One thing to point out about these funds is their expense ratios, which is the total amount of fees that investors pay to buy shares in the funds. These fees cover the costs of managing the fund, compliance, marketing, and distribution costs. TECB has an expense ratio of 0.4%, which means investors will pay $40 per year on every $10,000 that they have invested in the fund. But even if you subtract the fees from the numbers I just mentioned, TECB is way outperforming Tesla over the last 6 and 12 months. That doesn't make this fund better than Tesla stock, but it is more diversified, which lowers your risk of losing money when any one company underperforms. That's a big reason to buy ETFs in the first place. In fact, on a scale where 1 is the lowest risk and 5 is the highest, Morningstar rates TECB at only a 2. That means it has a below average risk score compared to 218 other tech-focused funds, while still getting a lot of the upside because every company in this ETF could benefit from the current AI boom. By the way, if you want to pick your own ETFs but aren't sure what to look for, I'll give you a few pointers a little later in this video. So make sure you stick around and watch until the end so you can see what I look for when I pick my own funds. And if you're looking more for individual stocks, check out Moomoo. Moomoo is a trading app that helps you find great investments and execute your strategies. There are no commissions, no account minimums, and no hidden fees. And they have a very powerful stock screener that lets you find stocks based on more than 100 different indicators. For example, I want to see all US semiconductor stocks with a price to earnings of less than 15 and operating revenue growth of over 30%. With just a few button presses, the screener shows me my results and the values for every field that I screened by. This is a very cool way to discover great stocks at great prices. But that's not even the best part. Right now, Moomoo is giving away up to 15 free stocks, each valued at up to $2,000. And if you use my link, you get another 2 free stocks. All you have to do is sign up with my link and keep your account above $1,000 for at least 60 days to claim your 17 free stocks. But this offer is only good until March 31st, so go download the app using my link in the description below today. Let's get back to the funds. If you think that a fund holding over 180 companies is spreading your money out too thin, then this next fund is for you. Coming in at number 3 is ARKK, which is the ARK Innovation ETF. ARKK is a thematic fund focused on investing in disruptive innovation. ARK Invest defines disruptive innovation as products and services enabled by new technologies that potentially change the way the world works. This ETF focuses on a few key areas: DNA technologies and the genomic revolution, automation and robotics in energy storage, artificial intelligence and the next generation of internet applications, and innovations in fintech. One thing that all of these areas have in common is they benefit from generative AI. For example, genomics companies will use it to discover proteins and drugs. Robotics and automation companies will increase the productivity of their programmers and their factories, and generate large training sets of data to train their own machine learning models. Software companies will come out with in-app co-pilots to help users get more value in less time. And I'm just scratching the surface. It's hard to imagine all the different ways that these new AI tools will impact every company over the next few months, let alone the next few years. ARK Invest's Innovation ETF is pretty different from every other ETF on this list in a few important ways. First, ARKK is an actively managed fund. That means ARKK's holdings can change every day instead of monthly or quarterly. That's a nice benefit because when a new company IPOs or an existing company makes a big breakthrough, it can be put inside this fund right away instead of waiting for the next time it's rebalanced. But it also means the expense ratio is much higher. The management fee for ARKK is 0.75%, or $75 for every $10,000 you invest. ARKK currently holds just 28 companies, which is much fewer stocks than are in TECB. In fact, ARKK's top 7 holdings account for over 50% of the fund by weight. Those stocks are Tesla, Zoom, Roku, Coinbase, Exact Sciences, Block, and UiPath. And Tesla stock alone accounts for over 10% of the fund. Because it's so concentrated in just a few stocks, this fund is much more volatile, which means higher highs, lower lows, and bigger moves in both directions. That's why ARKK was one of the best performing ETFs during the massive run-up in 2020, going up by over 300% in about a year. Likewise, it was one of the hardest crashing funds when tech stocks tanked over the course of 2022, losing around 75% of its value from the peak. Morningstar rates ARKK a 5 out of 5 on the risk scale and a 1 out of 5 on the return scale. So this isn't a fund that you want to go all in on, and you should be ready to hold it for a long time. But another huge benefit is that ARKK is not highly correlated to the S&P 500 or the Nasdaq, which means having a little bit of it in your portfolio can actually spread out your risk and provide higher returns under the right circumstances. That's actually a main goal of the fund. One more note about ARK Invest is that they have 5 other actively managed funds that focus on individual themes like genomics, robotics, and space exploration, and ARKK only includes the top stocks from those other funds. So if you're looking for somebody who covers ARK Invest's research and their stock picks inside these funds, consider subscribing to this channel because I cover their biggest trades every month. The third ETF on this list is AIQ, the Global X Artificial Intelligence and Technology ETF. This fund invests in companies that benefit from the further development and utilization of AI in products and services, or provide hardware for AI for the analysis of big data. In other words, the exact kind of companies that benefit from OpenAI's new plugins for ChatGPT and APIs for GPT-4. OpenAI just announced that they're letting companies build on top of their tools in exciting new ways, like AI travel agents for Expedia and Kayak, AI shopping assistants for Klarna and Instacart, or even work assistants and digital teammates by integrating with Slack and Zapier. And Microsoft, which owns 49% of OpenAI, is putting digital copilots in every product they have, from Excel to Explorer and even Bing. AIQ sits about halfway between the 2 funds we already covered. It has about 86 holdings, so less than half the number of the stocks in TECB, but over twice as many as in ARKK. And the top 10 stocks in AIQ account for 34% of the fund by weight. Those stocks are Meta Platforms, nvidia, Tesla, Salesforce, Microsoft, Apple, Cisco Systems, Alphabet, Adobe, and Oracle, which is a good balance between the stocks at the top of TECB and ARKK. AIQ has a total expense ratio of 0.68%, or $68 on every 10,000 invested. So it's closer to ARKK in terms of fees, but it has the same Morningstar ratings as TECB, below average risks for average returns when compared to other technology investments, making this a solid fund to hold. But there's one more fund on the list, and I saved the best for last. METV is the Roundhill Ball Metaverse ETF. Now, it may not be obvious why a Metaverse fund is on this list at all, let alone at the very top. This is where all the research really paid off. METV tracks something called the Ball Metaverse Index, which is a selection of companies that build or benefit from technologies that are critical to different areas of the metaverse, including hardware, compute, networking, virtual platforms, data services, digital payments, and content creation platforms, which are the exact same industries benefiting the most from new AI tools like ChatGPT and Midjourney right now. This fund is rebalanced quarterly, but in a pretty clever and unique way. Basically, the people who maintain this index rank every company as either a pure play, core, or non-core company to each area of the metaverse that I just mentioned. Then, they make sure every category in the index has enough stocks, that no single category makes up more than 25% of the fund, and that no single stock makes up more than 8% of the fund. As a result, the weighting system favors companies that contribute to multiple categories like hardware, compute, and data services. And what kind of companies are capable of doing that? The ones that already cornered one area of the market and can afford to branch out into others. The top 10 holdings in METV make up just over 50% of the fund by weight. And those companies are nvidia, Apple, Roblox, Meta Platforms, Microsoft, Qualcomm, Tencent, Alphabet, Sony, and Autodesk. The rest of the fund is also filled with more companies that you'd recognize, like Amazon, AMD, and Adobe. So ironically, the Roundhill Ball Metaverse ETF holds 50 stocks that will do just fine if the metaverse never becomes a real thing. 50 stocks is about 20 more than ARKK, but 35 less than AIQ. And the expense ratio is just 0.59%, or $59 on every 10,000 invested. That's cheaper than both ARKK and AIQ. METV launched in June of 2021, so it doesn't have a risk rating from Morningstar just yet. I'm not sure that would be a useful number for this ETF anyway, since the stocks are picked in such a unique way. Speaking of which, let me give you a few quick tips on what to look for when picking your own ETFs. First, it's important to know how the stocks inside the funds get picked. That way you're not surprised as their holdings change. If a fund says that it tracks an index, then just go look up how that index works. For example, the S&P 500 tries to hold the top 500 US companies and weighs them by their market cap. Apple is the biggest US company, so it should be at the top of the S&P 500 and any fund that tracks it. On the other hand, ARK Invest funds are conviction weighted, which means ARK Invest has their own scoring system to decide which stocks go in each fund and at what weight. And the Ball Metaverse ETF is somewhere in between the two. Either way, you should pick a fund where you like how the stocks are picked, not just which stocks are currently in the fund, because those can change. Another tip to think about is the overlap between the fund and the rest of your portfolio. For example, you might want to skip buying shares of ARKK if you already hold stocks like Zoom, Tesla, and Shopify, since you'd basically be paying that hefty expense ratio to buy stocks that you're already holding. On the flip side, if you love picking your own stocks in one area, like AI or software companies, you can find a fund that picks stocks in a completely different area, like healthcare or financials or real estate. That way you're diversifying how your stocks are picked, not just what stocks you hold. You should also think about how many stocks you're willing to hold in total. The S&P 500 has 503 companies in it. TECB has 183, AIQ has 86, METV has 50, and ARKK has just 28. More companies in the fund means less volatility, since a crash or a rally in any one company won't move the overall fund that much. Fewer companies means bigger moves in both directions, like we see when we compare the S&P 500 to ARKK. There's no right answer for how many companies should be in your portfolio, only the right answer for you. But before you go investing your hard-earned money into AI companies and the hardware platforms that power them, there's one more big disruption that you need to know about. So make sure to check out this episode next. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to share more research like this. Either way, thanks for watching, and until next time, this is Ticker Symbol U. My name is Alex, reminding you that the best investment you can make is in you.